Welcome to this strategic analysis of Hemas Holdings PLC, one of the biggest and diversified conglomerate in Sri Lanka. Next 15 minutes, I will explain you how Hemas has developed and implement their strategies based on the framework discussed during the session. The big number to begin with is the outstanding performance of Hemas in the financial year ended March 2026, where the company generated record earnings of Rs 8.92 billion. Its market capitalization has increased by nearly 24%, while its gross debt has decreased by 4.25%, reaching Rs 8.92 billion, increase of 10.7% from the previous year. That has done in a year there was a major cyclone and a major war which disrupted supply chains. Established in 1948, Hemas Holdings is listed in Colombo Stock Exchange since October 2003. It has been included in All Share Price Index as well as in S&P, which ranked the company in Sri Lanka's top 20 companies. The group is currently structured in three areas: consumer brands, healthcare, and mobility. Ashish Chandra became the group CEO from July 2025. His focus is to provide leadership for and drive group-level strategic initiatives in the next 5 years in collaboration with proven leaders who are leading each business unit. The strategies at Hemas function at three levels: of corporate, one for management of the overall portfolio, business unit level for each unit, and functional levels of strategies, both digital and supply chain, and people supporting execution underneath. Sri Lanka economy rebounded with a growth rate of 5% in calendar year 2025, with the industry shows a growth rate of 7.8% and serves 3.3%. That is tested by two shocks. In late November, Cyclone Ditwa struck all 25 districts and is estimated to have directly cost US dollars 4.1 billion. More recently, in March 2026, an escalating Middle East conflict causing increased volatility in fuel and key commodity prices. Using Porter's five forces in the context of healthcare, which is the group's largest segment, rivalry is considered to be moderate because there are already well-established private hospitals groups. Barrier to entry are substantially high because of process delaying due to healthcare regulation, licensing, and manufacturing compliances. Biopower is increasing as insurer and corporate health schemes acquire collective negotiation power, and supply power is moderately high as global pharmaceutical companies hold on to a significant portion of the input supply chain. Two things stand out: the distribution system it has established, penetrating both Sri Lanka and Bangladesh, and the consumer insight which has been established over decades, serving the same household in multiple categories. From capability building, the group is putting significant effort into digital infrastructure, new ERP and HR system, hospital management platform, Salesforce automation, cybersecurity, and even a data lab, which AI-driven tool. Average training hours per employees are improving on the people side, as hours per employee have increased by 46% to 14.2 hours on a headcount of 6,504 employees. Employee attrition has also declined slightly from 29.3% to 27.4%, but is considered a watch point as the group develop capabilities for the long term. Not one group strategy, but each part of competition is played differently. Consumer brands is a differentiation strategy where the Sri Lankan home and personal care business brings to the local market global trends, focusing on personal care, which accounts for 61% of the business portfolio, where beauty is being flagged as the priority growth category. It is a more focused exercise in Bangladesh with the value-added hair oil business to see their market share rising from 16 to 17.7% in the year under the company's what it's called Build for Bangladesh strategy, making that business portfolio from break-even status. Disciplined execution is still key to a good strategy. At Hemas, the performance of each segment is under its own leadership and accountable for its own results. The group has a leadership role in providing overall directions and capital allocation. Operational activities including structured improvement programs such as 5S, CASER, Lean Method and route optimization that works towards a continuous improvement of efficiency. It is an important part of the operational discipline and is one of the factors that contributed to the gross profit margin widening to 32% this year despite the macroeconomic disruptions. Digital transformation is part of the proofing that I discussed earlier, and talent development is regarded with the same importance. The strong increase in training hours shows that there is a conscious commitment to have workforce ready for work in the digital world with AI. As far as leadership is concerned, the appointment of Ashish Chandra as the Group CEO in July 2025 is continually of a direction and a new external viewpoint. His initial choices on digital capabilities, growth and synergy don't signal a shift in direction, but rather act as a continuation of the work already done. The first sign of a board's discipline is on governance, as they do not have to borrow but instead plunge back money from their business to finance the next stage of expansion. It's a very stingy risk taking by a company that is dedicated to creating value for its shareholders. The group is also reporting on their performance on 6 capitals: financial capital, manufactured capital, intellectual capital, human capital, natural capital, social and relationship capital. This gives a reasonably broad definition of performance and not just referring to the P&L. One area to note outright was the total contribution carbon emission were making this year, which increased from approximately 10,420 to 14,622 metric tons of carbon emission with the growth of the group. That's certainly a balancing act between growth and sustainability pledge that the growth will have to pull off in order to achieve its environmental goal by 2030. But now to the numbers, and most importantly the share price composition, which is a current or historical representation of the market interpretation of this strategy. The group revenue during financial year 2026 was rupees 127.4 billion, up 8% on the previous year by segment. Consumer brands grew 2.2% to rupees 47 billion. Healthcare grew 11.5 to rupees. No profit was made in the segment, which comprised primarily sales of Honda, Swift and Caser vehicles, 2.3 billion. Gross profit rose at a high rate than revenue, rise 11.7% to 32.5% of revenue from 31.4% the year behind. But EBITDA margin actually dipped slightly, 13.3% to 12.9%, and EBIT margin 11.6 to 11.1%. Management own reasoning is simple. It's used that margin save as well as the little more to invest in people, digital capabilities, and growing healthcare network, a conscious strategy of sacrificing some near-term margins for the promise of greater capacity in the long term. The bottom line was made a record because of a steep decline in financial cost, which declined by 6.9 from rupees 978 million to rupees 421 million. This enabled PAT to post a record rupees 8.92 billion, which is 10.7% increase, of which a single quarter alone was upward of rupees 71, the best quarter in the company history. The company reported positive earnings of rupees 2.98 from rupees 2.7 on the split adjusted basis. In turn, the price of a share in the same period, the market capitalization gained by 23.7% to rupees 88.7 billion at one stage, briefly surpassing rupees 100 billion before retracting in the aftermath of the cyclone and the Middle East turmoil, and stabilizing in March 2026. The Hemas share recorded a total return of 23.3% from the 12-month period, which was below the total return of the market as whole as measured by the All Share Price Index and the S&P. However, the most significant comparison is over the past 3 years, and Hemas has outperformed All Share Index with a cumulative total returns of 127.7% against 126.5%, as well as the S&P with 120.1% on a compound annual basis, that equate to 31.6% per year for Hemas versus a typical 31.3% per year for the entire index. So this year has been pretty bearish compared to the market, but Hemas has been marginally better long-term compounder than the market. The price to earning ratio also reads a re-rating tail, as it's winded from 8.9 times to 9.93 times, which suggests that investors have become more willing to pay a higher price for every rupee earned by Hemas. The reason why ROE has slightly decreased from 17.7% to 17.2 is just because the equity base has got expanded with the additional of retained earnings, whereas return on capital employed has improved to 32%, 2.1%. Each share of the dividend is rupees 0.95 and a payout ratio of 31.8%. A reasonable payout ratio, given that the company has decided to spend more on its own growth. I will end by proposing the 3 criteria for successful strategy in our course text. One, goodness of it, Sri Lanka's demographic and economic trends are aligned well with the Hemas strategy, and the resources are on par with the Sri Lankan context, which is okay. Second, competitive advantage, the whole healthcare package, the brand loyalty and the consumer recognition, in addition to the distribution system, and truly hard to copy. This test get a thumb up too. Third, performance record earnings, expanded gross margin, a growing market capitalization and a rising valuation multiple all indicates that the performance test passed as well. Looking back, overall it is prudent to say that Hemas Holdings invest in its next financial year have seen 2 major external shocks. One shock of a cyclone and one giant war for the world, and yet they still come out with a record profit and a better balance sheet. To me, that's the strongest proof that this is a strategy that coming together not just a good year. Thank you for listening to the strategic analysis of Hemas Holding PLC.